Welcome to this video on edge and risk. After completing this video, you will be able to explain the difference between edge and risk. You'll also understand the classification of edge into inefficiencies, risk premia, model-driven, and situational. Just like any other business, we need to buy things for less than their fair value and sell things for more than their fair value. Options don't give any advantage, just because of their technical specifications like asymmetric risk, fixed expirations, and the various structures that they can be combined into. Edge is the advantage you have when making a trade or a bet. It is why you can expect to win. To understand what edge is, let's take an example. Consider a coin that comes up 55% heads and 45% tails. If we win $1 for getting heads and lose $1 for getting tails, we have an edge. Over a large number of tosses, we expect to win 0.55 into $1 minus 0.45 into $1 per toss. Edge is the average value of a game. Another term for edge is expected value. Edge isn't necessarily the most common result, the mode, or even a possible result. Here, our edge is 10 cents, which isn't a possible result for one play. Edge isn't about math. It is about asymmetric knowledge. If everyone else also knew the coin was biased, we would have no one to play against. Knowing why your edge exists is important. When the reason goes away, you can stop trading it. The efficient market hypothesis is the idea that markets generally allow no edges. It was never meant to be taken as an absolute, just as a very good approximation. Which it is. Making money is hard. Categorizing your edge can be a good way of further understanding it and trading it differently. The first way to do this is to note that edges are either inefficiencies or risk premia. Other people haven't noticed. Inefficiency. Usually transient and capacity limited. You need to constantly look for new ones. Example, a stock index future is trading at a different price to that implied by the individual stock prices. People are paying you to assume a risk. Risk premium. Often very persistent and scalable. You can build a career around these. Example, stocks outperform bonds because stocks are riskier. Risk premia are not always mispriced, but they often are on average. But what is risk? A risk is any market variable that isn't an edge. Each trading strategy will have one edge, but will be exposed to other things as well. Because different traders have different edges, they also have different risks. Ideally, we would hedge all risks. We aren't getting paid, in the sense of having an edge, so we would rather not be exposed to the possible losses. Another useful categorization is into model-driven trades and situational trades. A model-driven trade is based on a model of the world. It gives us a theoretical fair value at all times for an instrument. An example is when we use Black-Scholes. These models scale very well, but it is hard to build models. A situational trade is where we don't know a fair value, just that something is underpriced or overpriced. An example is what happens when a company announces earnings. We hope you have understood the difference between edge and risk.